So I'm going to start this video off by asking you guys a simple question that applies to everybody watching this video. And as I walk through this sort of thought experiment and keep on asking you questions, which by the way requires zero prerequisite knowledge in finance or investing or anything like that, by going through this thought experiment and answering these questions, you're going to gain yourself a foundational level, solid understanding. It's not just going to be me giving you information. You're actually going to be able to explain to yourself and truly understand asset pricing, which is how assets are priced, which means you're actually going to gain an understanding about how expected returns are determined. And then toward the end of the video, I'm actually going to be showing you the implications of portfolio management and investing, and talking a bit at the end about how we can actually start to build really strong portfolios. So I'm going to go ahead and I'm going to walk through this example. So let's say that you are an investor, and everybody's an investor. Maybe you have some money in your savings account. Maybe you have a retirement account at work. And let's say in this universe, there's two different choices of what you can invest in. So we're going to start here by going through the example of the ice cream stand. And this really just represents any small risky business, right? So let's say this guy named John, let's say he wants to start an ice cream stand. Let's say he goes door to door and he knocks on your front door. And he says, hey, my name's John from up the street. I want to start an ice cream stand. I want to sell ice cream and make some money. But I have no money right now. I want you to loan me $100 so I can go ahead and buy some supplies to get started. So he needs to buy some ice cream. He needs to buy an umbrella. He needs a cart, right? So he needs $100 to get started. And we're just going to keep things really simple. So in this example, there's no equity ownership or anything like that. This is simply just a loan. And of course, he promises to pay you back with interest. So this is one of the choices you have. You can loan John $100 and you can earn some interest once he pays you back. Now, when we go and look at the details of this, we're going to say that he's actually terrible at making ice cream. We're going to say he has no reputation at all. He has a very unstable customer base. We're going to say that he might actually get shut down by the FDA, for example, right? So all of this should be screaming at you risk, right? This is a very high risk investment to make. He might go bankrupt. And of course, if you loan somebody money, whether it's a person, business, doesn't really matter. If you make a loan and the person goes bankrupt, they might not be able to pay you back. You might give them $100 and you could lose all of your money, right? So this is one option you have, is loaning $100 to John. The other option you have is actually loaning money to the Treasury of the United States. You can actually loan money to basically any government around the world, because governments issue bonds and whatnot. In terms of the U.S. Treasury, they issue, T-bills, T-bonds, and T-notes, Treasury bills. We don't need to get into the specifics, but basically the United States government needs funding. Some of that funding they get through tax revenue, and then some of it, of course, they actually sell bonds, which just means that you can loan the Treasury money and they'll pay you back with interest, same as John. Unlike with John, the United States Treasury is backed by the full faith and credit of the U.S. government. Which means it's very low risk. The Treasury doesn't tend to default on their debt, right? So this is a very low risk investment. There's almost a 100% chance that the Treasury is going to pay you back, unlike John, where they might go bankrupt. Now, of course, if you get more detailed and whatnot, even countries themselves have different credit ratings. Some countries are more likely to pay you back than other countries. But for this example, for all intents and purposes, we can just say that it's almost a 100% chance that they pay you back. So if this is all the information I give you, and you're an investor and you need to pick, do you loan your money to the Treasury or do you loan your money to John? And this is all the information you have, right? Which one do you pick? I mean, you can go ahead and think about it yourself. It should be a pretty easy answer. You're probably going to go ahead and give your money to the Treasury. And of course, if this is all the information presented to every single investor in the investable universe, just meaning all market participants, everybody's going to go ahead and pile money into the Treasury. Everybody's going to buy these Treasury bills and they're going to earn a little bit of interest, right, from these Treasury bills. And nobody's going to give their money to John. He might make a couple of pennies from his family and friends. But, overall, everybody's going to pile their money into the Treasury and nobody's going to give their money to John. So that was essentially, I explained the risk side of things. Let's go ahead and now look at the return side of things. So we're just going to make up numbers, of course, for the sake of explaining the concepts. Let's say that if you buy a Treasury bill, the Treasury is going to pay you a 1% interest rate. And for this example, we're just going to assume that the Treasury is so safe, there's actually a 100% chance that they're going to pay you back. That means that there's, of course, zero risk. There's no uncertainty at all. So to summarize, that means that the Treasury has a 100% chance of paying you 1% interest, right? Now let's look at John, right? So John might understand that, not everybody's giving him money because maybe there's better options available. He really wants to start this ice cream stand. He's upset that nobody's giving him funding. So let's say that he actually offers you 10% interest, right? That's for the return side of things. For the risk side of things, we're just going to go ahead and assume that he has a 10% chance of succeeding, right? That means that there's a 10% chance he's actually going to pay you the 10% interest that he promised you. And that means that there's a 90% chance that he's actually going to go bankrupt. So 90% of the time, he's going to go bankrupt and you're going to be completely wiped out and not get any of your original money back. So let's say that now this is the data that you have to go off of. You might say, okay, some market participants in the investable universe might go ahead and actually want to earn that 10%. Some people might give John some money, right? But if this is all the information we have access to, we're actually going to see the exact same thing. Everybody's going to pile their money into the Treasury and nobody's going to give John any funding. How come? Let's go ahead now and introduce a concept that we call expected return. Expected return just means the weighted average return that you expect to make over all of the different possible outcomes. So for the Treasury, since there's complete certainty and you know that they're going to pay you 1%, there's only one outcome, which is earning that 1%. So the expected return is going to be 1%. Easy to understand. When it comes to John's ice cream stand, we know that there's a 10% chance that he's going to pay you 10%. We're just going to assume that there's a 90% chance that you're going to earn, let's say 0%. You're not actually going to be wiped out, just to make things easier to understand. This means that the expected return is going to be 1%. And how you can think about that is that if you invest in 10 different ice cream stands, you can expect that one of them is going to pay you 10% and 9 of them are going to pay you 0%. So that means that on average, if you can find, a bunch of different ice cream stands to invest in, on average, you're still only going to earn 1%. So now we're starting to introduce more information. And if this is what you face, which one are you going to put your money into? You realize that that 10% interest that he's promising you doesn't actually matter, since on average, they're both going to pay you 1%. Would you rather earn 1% with no risk or 1% with a lot of risk? The answer, of course, is you'd rather earn 1% with no risk. Now, of course, in the real world and in the literature and stuff, some investors might be risk-seeking as opposed to risk-averse. We're not really going to get into that for the time being. You can just think of the correct answer as of being that everybody's still going to put their money into the Treasury. So now we're going to go ahead and we're going to say that John still gets no money. So now what? Now he's really upset because he really wants to start this ice cream business and he's not getting any funding. So now he's going to smarten up and he's going to say, okay, now I'm going to offer 18% interest, right? The risk stays the same. There's still a 10% chance that he's going to succeed. But if he does succeed, he's now going to pay you 18%. If we now go ahead and calculate the expected return, as if you can invest in, 1,000 different ice cream stands and take the average, the expected return is now going to be 1.8%. So now you can see that even when you account for the risk of investing in the ice cream stand, you actually expect to earn more money, even when you account for the risk, right? So now your expected return is going to be 1.8%. And now this investment becomes a lot more enticing to certain people that are willing to take on some risk in order to make more money. So now when we look at what happens, this is what you can see. The Treasury is still going to get some funding, and they might even get the most of the funding. It doesn't really matter. But now a couple of investors actually put their money, actually gave their money to John. And this is something really interesting, because if you think about it, all we did was change the incentives, and now John's able to get funding. And of course, we're just using an ice cream stand. Maybe this is a tech startup, right? Maybe this is something that's actually going to go on to make a difference in the world. Of course, we can talk about like Adam Smith's invisible hand and whatnot. We didn't actually force anybody or coerce anybody into doing anything they didn't want to do. And we didn't need to make the ice cream stand less risky. We just had to change the incentives. And now certain people and businesses can get funding and can go on to do the things they want to do just by changing the incentives. So this is something, really important to understand about markets. Don't worry if it doesn't make too much sense yet. We're just getting started. So now we're going to talk about what actually just happened, right? So in finance, in the literature, we essentially refer to treasury bills or T-bills as the risk-free rate. There might be a tiny chance that they might, default and not pay you back, but more or less, we can just refer to treasury bills as the risk-free rate. Now, when it comes to the ice cream stand now, that extra sort of differential, that extra amount that he had to pay you being 18% instead of 10%, we can basically refer to that amount as being something called a risk premium. And this is a very important concept, and we're going to be talking about this for the rest of the video. Any risky investment that wants to attract investors essentially needs to compensate the investor for taking on additional risk. And then the total return of the ice cream stand now, if you invest, is going to be the risk-free rate plus a risk premium, right? He doesn't just need to give you a positive expected return. He needs to give you a positive expected return so high that it's above the risk-free rate. So if the risk-free rate is 1% and he's going to pay you, on average, the expected return is 1.8%, you're earning a 0.8% risk premium. This is what we call a risk premium. And we're going to be talking more about this as we go on throughout the video. So these risk premiums, in the literature, we refer to these as risk premia. It's just plural of premiums. We also tend to call factors. So you can think of those as being interchangeable. For the rest of the video, I'm probably going to refer to these risk premiums as factors. So the type of risk premium that we went over in this example, in my opinion, I think it's really easy to understand, which is why I chose it. We call this specific risk premium the credit premium. What the credit premium means is that if you have one security that has a really good credit score, right? Governments and businesses have credit scores the same way that private citizens have credit scores. If you have the treasury with a really good credit score, they'll pay you some amount. But then if you have a business that is really risky and is not that creditworthy, in order for them to attract investors, they need to pay you not just more money, but more money in proportion to the risk that you're taking on. So on average, you can still expect to earn more despite the risk, right? This is what we call a risk premium. There's many different types of risk and many different types of risk premiums. In this case, this is called the credit premium, right? So there's a bunch of different types of factors, and not all risk actually has a risk premium. It's possible to take extra risk that can actually be bad for you, that does not pay you extra. We're going to be talking a lot about this in the video. Essentially, what factors are quantitative characteristics that are shared across a set of securities. You can really think of factors as being underlying independent sources of returns. Some might persist, some might not persist. Don't worry if you don't understand what I'm talking about. We're going to sort of take a step back here. This is just high level overview. We're going to take a step back and we're going to talk about all of this stuff. Now, factors are pervasive across essentially every single asset class. So the credit factor exists within fixed income, which are bonds, which just means loaning somebody money. There's also the term factor, which just means, for example, a 30-year bond should pay you more than a 5-year bond, for example. And then we have a bunch of factors within equities or stocks that might be more interesting for some people. We're going to be talking a lot about this as we move on. Don't worry if you don't understand yet. It's just important to understand that these factors are underlying risks. And if you expose yourself to that risk, you can actually expect to earn more money over time. So real quick, I just want to take a segue. Why am I making this video, right? So if you're a new viewer, welcome. If you made it this far, you're going to love the rest of this video, and you're going to love a bunch of other videos that I plan on making. If you're an existing viewer, you're probably saying, why is a computer science / software engineering / cybersecurity channel talking about asset pricing and investment finance, what's going on? Basically, a lot of people don't know, or probably almost nobody knows. But I actually study two things formally. I study, obviously, computer science. I'm actually in grad school right now studying to get my master's of computer science. But I also study finance, specifically asset pricing. I love asset pricing. That's what this video is on. But I also study, broader fields within investment finance, obviously financial economics, behavioral economics, monetary economics I actually started studying as well. So I study a lot and I go really in depth, and obviously I combine the two. I do a lot of computational finance, quant finance. When I first made the channel, I just made the channel my name just because I didn't want it to sort of specifically be about Python or, software. I just want to talk about everything I found interesting. This was one of my first videos on the channel, was about quant finance. I said, guys, I'm going to make this a series if it does well, and it didn't do well. I thought there was no interest. And then after over 2 years, 800 days, it started picking up. Everybody's saying, make more of this, make more of this. This video is not going to be a coding video. This video is accessible to everybody, but trust me, to everybody asking me to make more videos, there are going to be more quant finance videos. There's actually going to be a lot more finance content if there's interest. Anyways, and then here's some content saying, please make more, please make more. I've been saying for 2 years, oh, maybe I'll make more. Now I'm actually making more. Anyways, back to factors. Now, if you're still saying, I don't really understand what a factor is, what are you talking about? Don't worry, we're going to go through all that from the ground up. I just want to give a little high-level overview first. So with factors, like the credit factor, and the rest of the factors, value, momentum, size, blah, blah, blah. With factors, each factor comes with something that we call an asset pricing model. They go hand in hand. We're going to talk more about that later. I'm just going to give a high-level overview. You can think that these factors always existed within markets, but they weren't always known. They actually had to be discovered and published by researchers. So the start of this research, all this factor and asset pricing research, began with a single factor model. They discovered only one factor at first. And we're just going to sort of talk about within equity markets, within the stock market, probably for the rest of the video, just because that's the most understandable and what most people are going to be interested in. In the very first factor model that was published was called the CAPM, which stands for the Capital Asset Pricing Model. It was actually a couple of different papers published all around the same time that gave birth to the CAPM. And then next up was in 1992, a seminal paper was published called The Cross-Section of Expected Stock Returns by Fama and French, Eugene Fama and Ken French. They changed the way we approach asset pricing and all of finance. And they created a model called the Fama-French three-factor model, where they added in both the size factor and the value factor. We're going to talk more about that later. And then another seminal paper was published, I believe, in 2015 or so, called the Fama-French five-factor model, where they actually introduced two additional factors, profitability and investment. Profitability, I believe, was originally discovered by Dr. Robert Novi-Marx. There's also the momentum factor that was published. There's a model called the Carhart four-factor model. I actually made my own website where I actually combined some of these factors together. Fama-French didn't want to include momentum in their model because they're sort of like efficient market purists, so to speak. We're going to talk about efficient markets probably in a different video. Anyways, that was just a high-level overview. Last thing I want to mention before we get into it is there was actually a paper published called Taming the Factor Zoo. This was a meta-analysis done in 2020 where researchers went through and found that there were something like 300 or 500 different factors published in the literature over the past couple of decades. Basically how it works in finance and in other fields is some researchers play the short game and some play the long game. And if you're a researcher, you're a young researcher, if you actually find a real factor and publish it, you're going to get citations. It's going to be a massive kickstart to your career in research. So a lot of people essentially did data mining. They tried to publish factors, even though they might not be real factors. I promise you there's not 500 factors. There's definitely just a handful of factors in each asset class. Anyways, back to actually explaining things. Don't worry if you don't understand. That's just a high-level overview. Anyways, so I said for the rest of this video, we're really just going to be talking about factors within the stock market, just because that's going to be what is of interest to most people, especially young people. That's how you can really raise the expected return of your portfolio. So the very first factor, the one that's the most sort of just basic and easy to understand, is just called the market factor. It's also referred to as market beta, and also called the ERP, which stands for equity risk premium. So all this market factor means is that if you take every single stock in the entire global stock market, not just the United States, but the whole world, and you hold, all of these thousands of stocks in proportion to their actual market cap weights in the real world, we can essentially call this the market portfolio. And sometimes they say the market portfolio actually includes private assets, and we really don't need to worry about that for now. It just means you hold the entire stock. It just means the performance of the entire stock market altogether, which is investable. You can go into your retirement fund at work or personally, and you can just buy an ETF that exposes you to the performance of the entire stock market altogether on average. So now anything we do in finance and asset pricing, you sort of need to think about like equilibrium models, for example. Basically, everybody needs to own every stock, right? If somebody sells a stock, somebody else needs to buy the stock, right? Everybody needs to hold every single stock, and we can talk about new share issuance and all that later. But essentially, as an investor, if you can buy the entire stock market on average, which is very risky and crashes frequently, we're going to talk about that later, or you can just put your money into treasury bills, which are risk-free. Obviously, you'd put your money into treasury bills, but because everybody needs to hold every single asset, essentially what happens with asset pricing is that stocks are priced such that they have a positive expected return, and this is why the stock market goes up over time. This is how index investing works. If you buy an index fund and you're a boglehead or a couch potato or whatnot, you're essentially just harvesting the ERP, which is the equity risk premium. It just means that stocks are more risky, therefore they need to compensate you with a positive expected return. That's through the single factor lens. We're going to see later through the multi-factor lens that you can really push up your expected returns and also reduce risk. We're going to talk about that at the end of the video. So I'm going to be showing a little bit of math. It's really not a big deal. Essentially, the equity risk premium is equal to the return on the market minus the return on the risk-free rate. As we discussed before, it needs to, in order for it to be a risk premium, it needs to pay you more than what you could get otherwise just with T-bills. So let's go ahead and take a look now at the actual characteristics of the ERP, which is just the first factor published in the CAPM. So basically, this is how the stock market works. Most of the time, you're going to earn a very small amount of money, and then very infrequently, you're going to lose massive amounts of money, right? So I can go ahead and basically show you more or less how the stock market works is very, very slowly over time. You're slowly going to make money, and then very infrequently, boom, there's going to be a devastating crash. And then eventually you recover day over day, month over month, year over year. You're slowly going to earn money, and then boom, crash, right? Slowly recover, boom, crash. This is essentially the characteristics of how the stock market works, which is similar to how insurance premiums work. I'm actually going to touch on that in just a second. Actually, I think I talked about that right now. So you can think of these risk premiums as being analogous to insurance premiums. This might make it click for a lot of people that still don't really know what I'm talking about. Now, when it comes to these premiums, like the ERP, certain people can expose themselves to the risk and bear the risk and then earn the premium. We call this harvesting the premium in the literature. And then other people, other market participants, might actually not want the risk. They might actually want negative risk, which we would call insurance against the risk or hedging, right? Some people, some investors are different. We're going to talk about which one you might be in a second. And then other people actually insure themselves against the risk. And then the privilege of being insured against the risk actually costs you money. Those people generate the premium. So if you think of it, if you think of an insurance contract, let's say, car insurance or house insurance, right? You are actually the person insuring yourself against a risk, which is a privilege. Therefore, you're actually the one paying the premium. So if we think about that, it's just the opposite of investing in the stock market. So month over month, you're going to pay your insurance company your bill for your car insurance or motorcycle insurance. So you're going to lose $20, lose $20, lose $20 as you pay your car insurance. And then eventually, obviously, God forbid, but in the data, the average car driver will get into a car crash every some number of years. Obviously, it's not infinite years, right? Eventually, you're expected to get into a crash. And when you do, your insurance contract is going to have a massive payout. Let's say you get a $10,000 payout, right? Of course, maybe that needs to go toward your car repairs and whatnot. But from the financial point of view of that insurance contract, you basically lose a tiny amount of money most of the time and gain a large amount of money infrequently. And then you go back to just losing tiny amounts of money most of the time. It's essentially, there are mechanical differences between a risk premium in the stock market and insurance premiums, but that might sort of make it click for you what we're actually talking about. The insurance company in this case earns a premium and exposes themselves to the risk that you get into a car crash, right? Moving on, so this is what I was talking about. This is how an actual stock of an actual chart looks like of the global stock market. Most of the time it trends up, and obviously on average it trends up. And of course, if you can see the .com bubble and the 2008 bubble, of course the market goes up over time. This isn't a logarithmic scale. These might look like tiny crashes, but trust me guys, these are devastating crashes when they actually happen. You're not being paid for nothing. You get paid to actually bear risk. And we're going to model the risk a bit later. One more thing to mention about the stock market. This is pretty important to understand. This doesn't just go for the stock market factor, but it goes for all those other momentum, blah, 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 value size, the other factors I mentioned as well, is you can basically pick and choose how much risk you're taking. You can basically decide how sensitive you are to each factor. So in this case, we're still viewing the world through a single factor model, which is only the stock market factor. And we call these loadings, we call the sensitivity to the risk, we can either call it a beta or we can call it a factor loading, right? So the blue line here basically just means that this investor in their portfolio has a beta of 1, which just means that they are exposed to 1 times the risk of the stock market, which just means the stock market, right? The blue line is just what the stock market did. If you actually are willing to amplify your returns, let's say you have a beta of this orange line is going to be a beta of 1.5 or a factor loading of 1.5. This means that you're exposed to 1.5 times the risk of the market, but it also means that you're going to earn 1.5 times the risk premium of the market, right? So you're going to earn, let's say, double the money in good times when the market goes up, but then you're also going to lose double the money in bad times when the market goes down. And then same thing for this green line is a beta of 0.5. That just means, of course, that you're actually insulated, still exposed, but insulated. The important thing to understand is that a factor loading or a beta basically just means that you can pick and choose how sensitive you are to each risk factor. Okay. So now we're going to be covering a couple more examples. Now you sort of maybe understand what a factor is, and don't worry if it still isn't clear, it's going to become clear soon. Now we're going to be covering not just factors, but we're going to be introducing how we actually use factors and use asset pricing models to essentially give us information and evaluate returns. And the key term here is actually going to be explanatory power of a model. We're going to explain that shortly. So let's say that you are an investor, right? Let's say you want to invest some money, it's sitting in your savings account. You want to invest it in something else. So let's say you go to the bank, right? And I talk to my finance friends a lot of the time. And then I also talk to my non-finance friends. And a lot of them will literally go to the bank and say, hey, I want some help investing. And your bank will go ahead and say, great, we have a fund manager. He's so smart. They'll show you returns. They'll say it's so complex and he's so smart and he earns all these great returns. And they'll put you into a mutual fund or an actively managed ETF. It doesn't really matter the fund structure. Or let's say that you study finance yourself and you invest in the stock market yourself in your Robinhood account, or you buy a random ad from a Fidelity, you buy a random fund from an ad you see on Fidelity, blah, 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 whatever. It doesn't matter, right? But so this fund manager can either represent the actual performance of the fund you buy, or it can even just represent your own personal performance in your own personal portfolio. So let's say that your fund manager in a year returns an 8% return. If you have nothing to compare this against, and you just went to the bank and put your money in a fund and your fund manager gave you 8%, you would be happy. You would say, oh my gosh, this is so great. I'm going to tell all of my friends and family to put their money into this fund so they can earn 8%. In reality, the null hypothesis of investing, and yes, this sort of hinges on efficient markets, but it also just hinges on the fact that the equity risk premium exists, and nobody actually disputes that it doesn't exist. The null hypothesis, others have argued in the literature, and I would argue myself, that the null hypothesis of investing should be the market portfolio. In this case, we're going to simplify it down to just saying the global stock market. You should really, when you invest in equities, you should start with the global stock market, which is just an index fund, and then you should deviate and tilt away from it as needed. If you want to hold something else, that's fine, but you sort of need a really good reason of why you're tilting away. Now, let's say that the equity risk premium in this same year was 10%. Now you're not going to be too happy with your fund manager. You could have went and bought this global stock market ETF and earned 10%, but your manager only gave you 8%. So through this lens, and we're still not looking at factors yet, we're just looking at the ERP in absolute terms, but through this lens, your fund manager actually outperformed and you should be upset with them, right? And it's a little bit better to compare this way. But what we actually do is we do something called a factor regression, right? So different example. Let's say you're a little smarter and you now compare your manager to how the stock market does. Let's say the stock market does 10%, but your fund manager gets you 12%. What we call this in the literature is we call outperformance above a benchmark as an alpha. It's like the holy grail of investing. Everybody wants to outperform and do above average. So in this case, your fund manager delivered a 2% alpha, which means they outperformed the market by 2%. Of course, if you could compound at that year over year, you can get very rich, right? It's a big number. So in this case, you're going to be happy, you're going to be ecstatic, you're going to tell your family and your friends, oh my gosh, my fund manager is so smart and so skilled, he outperformed the market, right? And same thing. Let's say that you earn 12% yourself investing in your own personal account. Same thing. You're going to be super happy comparing these returns. But this is not a fair comparison, and we're going to see why shortly. So now we're going to introduce asset pricing models, and the key term here is going to be explanatory power. So asset pricing models essentially explain differences in returns between two diversified portfolios. So now we're going to introduce the concept of factor regressions. So bear with me. We don't really need to worry about the math. Don't be scared. This is just the beta sensitivity part that I talked about earlier. Basically, the return on an asset should be equal to your beta, which is your sensitivity to the market premium times how well the market premium actually performs, right? That's just what we talked about earlier with the beta of like 1 versus 1.5, right? You're just going to earn whatever the market earns times how exposed you are to the market. So let's say that we do a factor regression against the returns of your manager. A factor regression basically just means we're going to determine the beta. It just means that we're going to go ahead and figure out how exposed was your manager to the market. Maybe they were more exposed than one, maybe they were less exposed than one. If they held the market themselves, if you did this on an index fund, the beta would just be 1. So let's say that through the CAPM lens, when you do the factor regression, the beta of this fund is now going to be 1.5. So what this means, right, you're sort of, for lack of a better term, let's say that your God-given right, if you bought an index fund with no active management, and then you dialed up your beta to 1.5, and we can talk more about how you actually do that. You can do financial leverage, which means you borrow money. You can actually concentrate in higher beta stocks. You can actually use derivative leverage like options. We don't need to worry about how, but if you just buy this null hypothesis stock market portfolio and you dial up your beta to 1.5, if the stock market did 10% in a year and you bear 1.5 times the risk of the market, it means that your expected return should be 1.5 times the return of the market, which would be 15%. So if you take on a beta of 1.5, you should have expected to earn 15%. Since your fund manager only earned 12%, they actually underperformed, right? It looks like they overperformed if you just compare them to the market. But guys, what you really need to do is use a risk-adjusted benchmark. You need to basically compare the performance of your manager to a risk-adjusted benchmark. And we derive the risk-adjusted benchmark like this by doing a factor regression. It turns out that he took on so much risk that he should have been compensated with a 15% return. Because he only got a 12, he actually underperformed. You should actually be upset with your fund manager, not happy. And, you would only know this if you knew about factors and did a factor regression. And of course, once I make more quant finance videos, we're going to be covering how we actually do this mathematically and do it in code. I'll talk more about that at the end of the video. Now, same is true for vice versa. Let's say your fund manager returns 8% in a year, the stock market did 10%. You're going to be upset that he underperformed. But let's say when you do this factor regression, the beta was only 0.7, right? So, quote unquote, your God-given right return, let's say, if you have a beta of 0.7, it's going to be 7%. Because he took on an amount of risk that should have compensated him with 7%, but he earned 8%, this actually means that he had an alpha, and he actually overperformed. I just realized I messed that up. Don't worry about that. This would actually be, a good thing in this case, right? So it goes both ways. So when we use the CAPM, which is an asset pricing model, to explain these differences in returns, right, which is explanatory power, we find that in the research that only 2/3 of the differences in returns between two diversified portfolios are explained. That means it's a powerful model since, 2/3 of what we thought might be manager skill is actually not skill, but just compensation for exposure to known risk factors. That still means that there's 1/3 of differences in returns that are still not explained. And there's also a debate that says, well, wait a second, maybe the manager was skilled to know to be exposed to certain risk factors, and, that's kind of a different debate. Anyways, this is where we get into multi-factor models. So yeah, maybe this looks scary, but all this means is that through the multi-factor lens, the expected return on an asset is equal to your sensitivity to factor 1 times the return on factor 1, plus your sensitivity of factor 2 times the return of factor 2, right? Plus your factor loading, we call it, on factor 3 times how well factor 3 did. It basically just means that you can decompose returns into how exposed you are to each factor times how well each factor did. Now, modern, current day multi-factor models actually explain 95% of the differences in returns between two diversified portfolios. That is a large number. Now, the remaining 5%, is that skill? Is that luck? We need to talk about efficient markets. We can get into that later. But for all intents and purposes, 95% is a massive number. You can almost, in a way, think of that as being almost 100%, right? Like almost any differences can just be explained by exposure to known risk factors. So let's go ahead and just run through a super simple example. Let's say that your fund manager turns 17% in a year, so you are ecstatic. You are so happy that your bank is so nice that they put you into this fund. Let's say that through the CAPM lens, 10% of that was explained away by exposure to the market. So your manager is not skilled. You could have earned 10% of that anyways. Okay, he still has a 7% alpha. Now let's say we do a 3-factor regression. This now adds in size and value. We'll talk more about that later. But let's say through the 3-factor lens, we say, wait a second, your manager isn't really smart and he's not really good at getting high returns. He just had positive exposure to the size and value factor. That just means that he took on the size and value risk, which are real risks. And as such, right, remember the beginning of the video, when you take on one of these priced risks, you are expected to be compensated by earning a risk premium. So let's say that 5%, right, an additional 5% can be explained away by he's just earning a risk premium that you could have earned anyways, with more diversification and less costs and, more transparency. Now let's say we do a 5-factor regression in the Fama-French model that adds in profitability and investment. Now let's say that the factor model successfully explained away 100% of the differences in returns. Your manager didn't help you at all. He just took on more risks that are compensated. You could have went and decomposed that and took on those risks yourself. It would have costed you less money. There's a great paper, seminal paper published by Bill Sharp called The Arithmetic of Active Management. In reality, your fund manager would probably, on average, end up underperforming net of fees. Anyways, that's a story for another day. Basically, we need to know that we can use these multi-factor models to attribute essentially manager skill to compensation to known risk factors that you deserve anyways for exposing yourself to that risk. So that was a lot. We're going to take a little bit of a break now to sort of recap everything in very simple terms. If you still don't understand these factors, don't worry about it. We can talk more about them later. But essentially, what these factors are analogous to, I think this is actually a pretty good analogy, would be the difference between food and the underlying macronutrients, micronutrients, and calories, right? So if you, for example, eat a hamburger, your body doesn't know what a hamburger is. Your body doesn't care that you ate a hamburger. Your body only cares about the underlying macros and calories and micros within the burger, right? If you're trying to lose weight, you might say this hamburger is so healthy, the bun is just bread and the meat is just meat and it's full of vegetables, right? It has onions and tomatoes and lettuce and the cheese is some dairy, some protein, right? You might say the burger's so healthy, of course I can eat it to lose weight. But if you look at the macros, it might be full of fat, it might be full of calories, right? Same as a salad. Maybe you say, this bowl of salad's so big, I can eat this bowl of salad. But in reality, right, if you do like a quote-unquote factor regression, right, and you look at the underlying calories within that bowl of salad, maybe there's not that many calories. Maybe it's actually going to help you lose weight, right? This is the analogy I like to draw, because to your body only cares about micros and macros and calories. It doesn't actually care that it came in the form of a hamburger or a salad or whatever it might be. It's the same thing for funds. What really matters to you, the investor, is what underlying independent priced risks you're exposed to. That is very important. And then your actual return is determined by your exposure to those risks. That's the actual thing that matters to you at the end of the day. And we're going to talk more about this. Being in some fund called, super duper fund, blah, 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 that your bank markets and says, right? That doesn't actually matter. It only matters what the fund's exposed to. Anyways, hopefully that made sense. So now we're going to loop back in with what I talked about at the beginning of the video. And we're going to shed a little bit of light on what these factors actually are, right? So on the fixed income side of things, there's really only two factors called term and credit. In term, technically, might be referred to as duration. We can talk more about this later. When I do the Python videos, we're going to be actually modeling risk and return. We're going to be doing stochastic modeling. We're going to be doing a bunch of stuff. But credit is self-explanatory. Credit just means that if you loan money to somebody that's more risky, they need to pay you more than somebody that's less risky. Term, as I said, let's say a 30-year bond is more risky than a 5-year bond because there's more risk when interest rates change, right? That's called duration risk. So they need to compensate you more. When it comes to the stock market factors, it's a little maybe more confusing. The market factor makes sense. The total stock market's very risky because it crashes over time. That needs to compensate you above treasury bills. As for the other stuff, in the literature, size is referred to as SMB, at least in the famous French literature. That just means small minus big, which means that small stocks need to provide more of a return than large stocks. Now, in reality, there's a lot of nuance. There was actually a paper published called Size Matters If You Control Your Junk, which basically we have better data now than we did in the 90s. We have crisp data now, really good high-quality data set. And essentially, some of the small stocks basically had delistings. There's a delisting bias. Also, there's a segment where small cap stocks with like weak profitability, I believe, or small cap growth with weak profitability was a drag on returns. Some other research came out that said other factors are amplified with the small caps. I know I'm just talking, I mean, like I can really talk forever. As I said, like just as much as I studied computer science and software engineering, I studied finance and asset pricing. Probably like the hardest decision I had to make in my life was like, should I do my undergrad on the finance side of things, or should I like study computer science? Anyways, whatever. I mean, this video is like unscripted. Obviously, I'm just talking. That's aside. For this video, you can think of small outperforms large, right? Good enough. For value, that's referred to in the literature as HML, which means high minus low. They're specifically referring to a metric we call book to market. It means high book to market outperforms low book to market. All that really means is just that cheap stocks outperform expensive stocks. Profitability is RMW, which is robust minus weak profitability. Now, you might be thinking, shouldn't stocks with weak profitability outperform because it's a risk premium and a risky stock should outperform? Why would stocks with robust profitability outperform? There's a really, really good, really elegant, really nice explanation for why stocks outperform with higher profitability. To understand that, we need to understand discounted cash flows, which I'm not going to put into this video. I'll definitely make a video probably dedicated just to how profitability works and how all these factors work. Investment just means conservative minus aggressive. You don't need to worry about that. And then momentum means that stocks that trend up over time tend to keep on trending up, and stocks that trend down over time tend to keep on trending down. Okay, so this is going to be really important. Probably one of the most important parts of the video. What makes a factor a factor? So we mentioned the factor zoo, where there's been hundreds of different factors published. I promise you there's not hundreds of different factors. There's only a couple in each asset class. And by the way, these factors are pervasive across all asset classes. They exist in commodities, everything. It's not just stocks and bonds. That's just what I'm talking about in this video. So what actually makes a factor a real risk factor? Because you can expose yourself to a bunch of risk, but it might not actually pay you with a risk premium. And also, there can be a factor that pays you with a risk premium historically, but it might not be expected to persist going forward. So let's take a look. First of all, it needs to be persistent. This means persistent across time. So this means that it needs to show up in multiple different time samples, right? It can't only work in a certain 10-year sample. It needs to persistently pay you a risk premium over a long sample of time. Second, it needs to be pervasive. When we say pervasive, this means pervasive across geographies, pervasive across countries, pervasive across sectors, potentially even pervasive across asset classes. It can't only, you can't say, because you can do data mining and a researcher can run a bunch of numbers in Python and say stocks that start with the letter A do better than stocks that start with the letter B, but it's only in Italy, and it was only from 2008 to 2016, and that's so specific, you don't actually expect that to be a real factor with a real risk. Of course, if you run enough numbers, we call it, if you torture the data, it will tell you whatever it wants, right? This is really important. Factors need to be robust to alternative specification, right? So what that means basically is that if you define a risk factor, it carries a certain risk, and you can't, so like HML, for example, is the value factor, which means cheap stocks outperform expensive stocks, specifically high book to market outperforms low book to market. Now, the principle is that cheap stocks are riskier. If you change how you define cheap, the factor shouldn't go away. If it goes away, it might be data mining. AQR, I believe, which is one of my favorite firms, by the way, they publish excellent research. There's a point in my life, actually, a couple of years ago, where I would wake up every single day and I would just read so much AQR research. I mean, I would read like Journal of Finance, Journal of Portfolio Management, but I would specifically read AQR research. I would read like sometimes 2 papers before I even ate breakfast. Like I love finance so much, so interesting, right? Anyways, what was I saying? Yeah. So AQR, I believe, uses they use like a composite ensemble metric for their value. They use like 25 different underlying signals to define value. So if you change book to market to like price to earnings, the premium shouldn't go away. Cheap does better means cheap does better. If you change how you define cheap, it shouldn't go away. Lastly, it needs to be investable. This means that you need to be able to cost effectively capture this risk premium in your portfolio. If there's a premium that pays you 0.5% a year, and let's say that there's not that much capacity and there's a high turnover rate, and let's say that it's so expensive to capture this factor in your portfolio that it costs you 1% a year to capture a premium that pays you 0.5% a year, obviously you're going to end up losing money if you try to harvest the risk premium. So it needs to be cost effectively able to be captured and harvested in a portfolio. The momentum factor is actually something that suffers with high costs. The momentum factor is a very high turnover factor, which means that, the stock in the momentum portfolio that has positive momentum, it will dwindle out and you need to sell it and buy a different stock. And every time you do trading, you're exposing yourself to fees and spreads and things like that. There's also a concept of capacity where there's only a certain amount of money that can go into each factor before the prices get bid up, the spec returns go away. Anyways, I'm just rambling. There's so much to talk about. I've read so much research about this. Anyways, moving on. So why do factors have higher expected returns? Well, I already told you at the start of the video, it's compensation for risk. So obviously, factors are risk factors. They're risk and they have high expected returns because they're risky and you don't want to bear risk. You need to be compensated to bear risk. That's true. So one of the reasons why they have higher expected returns is because of their risk-based explanation, right? So cheap stocks, for example, outperform expensive stocks. Well, if a stock is cheap, there's got to be something wrong with it, right? Think of Blockbuster. Blockbuster is not going to have really strong metrics, right? 10 years ago or whatever, it was sort of on the way out. If a stock's cheap, it's got to be cheap for a reason. There's got to be real risk involved. Maybe they're going to go bankrupt, right? So that risk-based explanation is almost, you can think of being like the true explanation for a risk factor. These sort of should be risk factors under the hood, at least through the efficient markets lens. Don't worry if you don't know what that means, though. The second reason is the behavioral-based reason. So momentum, for example, the reason why Fama Fringe didn't want to include momentum into their 5-factor model is because they're sort of like efficient market purists, and well, we'll talk more about that later, but basically behavioral-based means that it has a higher expected return, not because it's more risky, but because people are essentially just making errors in pricing assets, right? Maybe they have underlying mental like prejudices or something. Maybe they don't like certain stocks and they like other stocks too much. Think about like Tesla or something being bid up or whatever. Like, why are there bubbles and stuff? Like, does it actually deserve a high valuation, or are people being irrational, right? And if people are irrational, that can basically lead to risk premiums showing up that aren't actually a risk premium. They're just in aggregate less desirable to hold due to an illogical reason. Now, when it comes to the behavioral-based explanation, there's 2 sort of cases. One is you might actually expect it to persist. This would be a great deal for you. If you can earn a higher expected return, not because it's more risky, but just because people are being irrational, that's great. On the other hand, once the premium gets published and once people are aware of it, they might correct their irrational behavior, and then it might actually be expected to disappear, and then you're going to go ahead and add all this cost and complexity to harvest a factor that's going to disappear. This would be terrible, right? The risk-based one, yeah, you need to bear risk, but at least it won't go away. And then, of course, people talk in the literature about intellectual honesty. Of course, theoretically, any factor could just be data mining. Like I said, maybe there's no relationship, even if it's persistent and pervasive and all that stuff. Maybe it's just coincidence. Of course, we don't believe that to be the case, but it's something you just need to take into account. Okay, now we're going to talk about something called in-sample versus out-of-sample returns for these factors. So, for example, when a factor first gets published, there's some amount of data that goes into the research where researchers find the factor. So, for example, the cross-section of expected stock returns, that seminal 1992 paper published by Fama and French, their sample, and the CRISP data starts, I believe, in 1994 or maybe 1995 or something. But their data set for this, which spanned, multiple different countries and whatnot, their sample started in 1963. The paper was published in 1992. Their sample ended in 1991. So they had a good chunk of data to go ahead and determine that, yes, size and value are real factors. But then what happens is you now publish the factor, and the whole world and all the market participants become aware of the factor. And then from when the paper's published, you can just call it to the present day. This is now out of sample. And what you really need to ask is, does the factor premium still show up out of sample? Sometimes it will go away. Sometimes it will persist, right? In general, what tends to happen is a mixture of the two, where the factor premium, as more people go into it, if it's a little bit of a risk-based and a little bit of a behavioral-based explanation, the behavioral-based explanation sort of might be arbitraged away. Also, there's capacity constraints. More people go into the factor, right? More people want to bear the risk. So in reality, there might be like a little haircut where the premium goes down in magnitude, but it still persists, right? And for all the factors that we think are real factors, of course, they persist out of sample. That's what makes them real. Okay, another thing to mention is the concept we call states of the world in economics. This also shows up in the literature as being called regimes. For example, you can have a value regime or a growth regime. It just means a sort of state of the world. Now, we mentioned at the start of the video that the ERP, right, the equity risk premium, the stock market as a whole, it pays you a tiny amount of money most of the time, and then infrequently you face devastating losses. That is true. That is how the market works, but there's a little more nuance. So now, as I said, a risk premium, you're not making money for nothing, that you're bearing real serious risk to earn this money, right? So how it works with the stock market, how these state variables kind of work, is you gain money in good times and you lose money in bad times when it hurts the most. Now, just to make things easy to understand in this video, we can think of good times and bad times as just being essentially correlation with your own human capital. Human capital just means your earnings from your labor, from your job, right? So for example, when the market, let's just say, once a decade, it will have a crash, just to give you a tiny idea of magnitude, right? And obviously we're going to model this later. But let's say that once a decade, there's a crash. It's not going to be a random point in the decade when it crashes. It's going to crash when you lose your job and when your callable debt gets called away from you, when you get margin called, when you can't make your mortgage payments, right? When you suffer financially in real life, that's when the market's going to crash. So you're not just earning this risk premium, for some uncorrelated risk. You're earning this massive return, that can make you wealthy over time because you're going to get kicked while you're down, right? It's a real risk, but different people are exposed to different risk, right? So let's go ahead and take an example here. And all the time, people will ask me, especially when I talk to my non-finance friends, they'll ask me, what do you invest in? What should I invest in? What's the best portfolio? And that's the wrong question to ask. There's no such thing as the best portfolio. The market portfolio is the average portfolio. If you are the average market participant, then you can just hold the market portfolio, which is actually a pretty good choice for most people. But you need to look internally at your own life. So, for example, let's say that you're a tenured professor or a judge, and let's say that your human capital, which just means your labor earnings, let's say have no correlation with the stock market, right? So if you're a tenured professor, if there's a market crash, let's think 2008, right? All these tech companies are losing their funding, right? Nobody's giving funding to anybody. Everybody's getting laid off. If you're a tenured professor or a judge, you're actually not going to get laid off. It doesn't really matter what happens in the economy. You're relatively insulated. This means that the market crashing really isn't that big of a deal for you because your job is super stable. This means that it's massively beneficial for you to just go, leverage on stocks, right? You can do whatever you want and make a bunch of money because you're relatively insulated from the market. An even better example would be somebody that has a career with a negative correlation with the stock market. A great example of that would be, let's say, a divorce lawyer, or an even better example would be a bankruptcy lawyer, right? Think about when 2008 happens. Divorces, of course, go up. Everybody's hitting up divorce lawyers. Everybody's going bankrupt. People are going bankrupt. Businesses are going bankrupt. They need a bunch of, bankruptcy attorneys to deal with things. Those people are the most insulated people when it comes to stock market crashing, right? You're going to make even more money when the market crashes, so you might as well just go all in on stocks. On the other hand, let's say you're an engineer at a tiny little company. Let's say it's a pre-earnings tech startup, right? If a 2008 type event happens and your VC firm pulls back the funding, guess what? They're not even going to be able to pay your salary. You're going to get laid off, and the market's going to crash at the same time you get laid off. Now you're really screwed, right? Now you're going to need to sell off your portfolio at a 50% drawdown to make your mortgage payments, right? Now you're in trouble. Now, by definition, most people fall into the engineer at a pre-earnings tech startup type of thing. Most people's human capital, just meaning labor earnings, is positively correlated with the market. That's actually why the risk premium exists in the first place. And some people actually choose to hedge, do things like that. And then another thing that happens is a lot of people go even more extreme and they hold a massive amount of stock of the specific company they work for through stock options and whatnot. And that's really putting all your eggs in one basket, because now you don't even need a global disaster to happen. Your specific company can go bankrupt, go out of business. Now your stock portfolio is wiped out and you're unemployed at the same time. That's not really great risk management either, right? So when we talk about portfolio construction, there's a lot to take into account. Okay. Last thing about this sort of states of the world type of thing is we're going to talk about priced risk versus idiosyncratic risk. So remember at the start of the video when I mentioned a risk premium means you bear risk, right? And then as a reward for bearing risk, you earn a higher return. Now, not all risks are priced risks. Some risks are real, terrible, devastating risks, but they don't carry a higher expected return with them. Those are risks you want to avoid. Those risks we call idiosyncratic risk. The general rule of thumb is if the risk can be diversified away, it's idiosyncratic, and you don't want exposure to it. You only want exposure to underlying priced risks. Those are the actual factors. So let's say there's two states of the world. Let's say the world can either be sunny or it can either be rainy. And let's say there's two different things you can invest in. You can invest in an ice cream stand, unrelated from John's ice cream stand. This is just a generic example. Or you can invest in a rain jacket store. So as you might expect, in the state of the world where it's sunny, everybody's going to be on the beach buying ice cream. Let's say the ice cream stand stock goes up a bunch. And then the rain jacket store, of course, is almost going out of business. Who's buying rain jackets on a sunny day? Obviously, when it's rainy, now nobody's on the beach buying ice cream, and everybody's in the rain jacket store buying rain jackets, right? So let me go ahead and draw this out. So what this means is that if you invest in only the ice cream stand when it's sunny, right, you're going to end up making a bunch of money when it's sunny, and then it's going to crash when it's raining. Alternatively, if you decide to make 100% of your portfolio the rain jacket store, you're going to do terrible when it's sunny, and then you're going to make a bunch of money when it's rainy. Now, if you think about it, the weather risk is a real risk. You don't want to have this massively volatile portfolio. What if there's too many rainy days in a row and now you go bankrupt, right? It's a real risk, but this risk is able to be diversified away, which means you're not actually going to be compensated for bearing, we can call this weather risk, right? Because what you could do is you could just make your portfolio 50% of the ice cream stand stock and 50% of the rain jacket stock. And now what your average return is going to look like, assuming both have a positive return on average, is it might look something like this. You're going to go up over time. You're going to earn the average return, but you're not going to, but your risk is going to be, more or less, you can think of almost like a straight line. There's not going to be that much risk because you've diversified away the weather risk. Now, we really get into this when we talk about mean variance optimization and Markowitz and the efficient frontier and the tangency portfolio and blah, blah, blah. We're not going to get into the super specifics of how mean variance optimization works. But essentially, you only want to target real risk factors. You don't just want to pick specific stocks that are risky because it's not going to help you. Okay. And then, yeah, as I'm saying, maybe you want the 50-50 portfolio. In this case, would be the best. Okay. Last thing, probably, or one of the last things we're going to cover, which is really important, is let's say you're on board, right? Let's say that you invest in actively managed funds and you watch this video and you're like, wow, I'm paying 2% a year and losing that, every year that could have been compounded, right? There's real serious, consequences to paying too high of a return. Or too high of a fee to a manager, or maybe you're an index fund investor, which is a good thing. It's actually good. Index funds are completely fine. The only thing is you're only targeting a single priced risk. Why not target multiple priced risks? We're going to talk about that in just a second. So let's say you're on board. Let's say you pick your factors that you believe in. They're pervasive, they're persistent, blah, 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 right? Now you have another choice, which is, are you going to target these factors jointly, or are you going to target them separately? So in this case, we're just going to talk about value and profitability. So let's say that you believe in value and profitability, you did the analysis, you want to be exposed, and you want to harvest the value premium and the profitability premium. So what do I mean by targeting, right? So let's say that in this example, we're going to target these separately. This means that you're going to hold a value fund, and then you're also going to hold a profitability fund, and they're unrelated funds. You need to buy two different funds. So for the value fund, you're going to do a univariate sort on whatever value metric you pick, right? Price to earnings, price to book, whatever. And you're going to have a bunch of low value stocks and high value stocks. And let's just say, for the argument, you just grab the top 3 deciles of the most value-y stocks and you call it a day for your value fund, and you go ahead and do a univariate sort of profitability. You grab the top 3 deciles of profitable stocks and you call it a day, and you hold, half value, half profitability. That's one way you can do things. Another way you can do things is you can do a bivariate sort that target value and profitability jointly. So you're going to do a single bivariate sort on value and profitability. You're going to have low value plus profitability, high value plus profitability jointly, and then you're going to grab the top 3 deciles of both of those metrics together. Now, different factors should be targeted jointly and different ones should be targeted separately. And going into the super, details of portfolio management, we can do in a different video, and we can do analysis of all this stuff. Specifically with value and profitability, these should almost certainly, in my opinion, and in the opinions of others and the data that shows up in the literature, these should be targeted jointly. And I can explain why in a different video. We need to get a little more mechanical for the why, but it makes way more sense. You can get a lower risk and a higher return if you target these jointly. So that's just something else to be aware of. Okay. Closing thought for the video, and I'm going to cover one more thing when we're done with this, but the closing thought for the video, I said at the start that I was going to cover how we can start to build really, really strong, really good portfolios. Now, we know that, the quote is diversification is the only free lunch on Wall Street, right? And it's true. It's true. It comes from Markowitz mean variance optimization and whatnot. And it's true. Most people are on board. Even if you're an index fund investor, you hopefully diversify across geographies, right? Across countries. You're not only going to hold stocks from one country. You're not only going to hold stocks from one sector, right? We know that diversification in general tends to be a good thing that helps a portfolio. Now, what index fund investors don't do, and what a lot of people don't do, is they don't actually diversify across the factors, even though, a lot of people don't even target factors at all. But even if you do, you want to diversify across the factors, because the factors, as I mentioned, are the actual underlying independent sources of risk and return. These things, generally aren't correlated. Now, it depends if you're actually harvesting these factors in a long-only portfolio or a long-short portfolio. Of course, we're going to talk about that later. But just as an example, let's just go ahead and say this is year 1 and this is year 10. And of course, the numbers are made up just to sort of show you the examples. But, as I said, every single factor, including the stock market and the size value, the profitability factor, the value factor, let's say that every single factor breaks once a decade. And there's actually a quote from Cliff Asness. He actually runs AQR, Applied Quantitative Research. It's one of my favorite firms that publish really good research. I forgot exactly what the quote was. I heard it a few years ago on a podcast. But he was saying something along the lines of, if your mechanic is only able to fix your car 51% of the time or 60% of the time, you're going to fire your mechanic, right? But when it comes to portfolio management, you might target a portfolio that only works 51% of the time. On average, you'll make money, but a lot of time it breaks. And, for lack of actually looking at the data, let's just say that each of these independent factors breaks once a year. Let's say it crashes once a year, or even worse, let's say that it has a performance of, 0% over a whole year. So let's say that we draw out the market factor. So you buy the stock market, right? Slowly you make money. And then once every 10 years, there's going to be a devastating crash, right? This is market. If you're an index fund investor, you are exposed to the risk of, having your portfolio break one time a year. Now let's go ahead and say that you also add the value factor. Let's say that the value factor, it also breaks once every 10 years, but because these are independent sources of return, it will break at a different time, right? Now let's say because you're a multi-factor investor, let's say that you invest in, the momentum factor, and the momentum factor, let's say, also makes you money, and it breaks once every 10 years, but it breaks at a different time, right? This is how diversifying across the different factors work. And it won't be this dramatic if you're a long-only investor, but the same principle applies. If we go ahead now, and if you want to take a look at what the average portfolio might look like, it might look something like this, right? All the different risks cancel out. You still get, the higher expected return of the premiums, but because you're buying 3 or 4 or 5 different things, they all break once a decade, but they all break at different times in the decade. This is how we can start to build really strong portfolios. You don't just diversify across geographies and whatnot. You want to diversify across independent sources of return. This is like really the sort of kicker of this video, is you want to diversify across the different risk factors, and this is how we can start to build really strong portfolios. Now, there's a bunch of other things. Obviously, this is all simplified. There's a bunch of other things you can also do to build even stronger portfolios. As I mentioned, targeting jointly versus targeting separately, you can actually do things that are neither. For example, what I do personally, what really is good to do that shows up in the research, is you can take momentum, and instead of targeting momentum, you can use momentum as a negative screen, which means that let's say you invest in value stocks, which are cheap stocks, and eventually one of those cheap stocks does so well, it becomes an expensive stock, and now it's time to kick it out of the value portfolio next time you rebalance because it's no longer a value stock. If it has positive momentum, guess what? You might as well just hold on to it for a little longer until that positive momentum runs out, and then you can sell it, right? Same goes for buying a stock. If a stock enters the buy list, but it has negative momentum, you might as well wait for that to dissipate, and then you buy it, right? This is called using screens, like trading screens. That's a momentum screen. That's another way that you can make better portfolios. There was also some research done on security lendings rates. We can talk about that later. Also, following an index is actually a pretty bad thing, since a lot of indices publish their holdings ahead of time, and then the funds go into rebalance later, and everybody knows what the fund's going to buy because the fund tracks an index, and that's a directly observable thing. And then they can front run the index and bid up the stocks before a bunch of cash flows come in because they're contractually obligated to trade on a certain day when they say they're going to rebalance. What some funds do, and what I do personally, is you can gradually, over a couple of days, a couple of weeks, slowly start to buy stocks so you don't get front run and you don't bid up the prices too much by having a bunch of demand happen in one day. There's a lot of things and a lot of nuance that goes into proper portfolio management. All of these principles matter, and we can talk about all of these in upcoming videos. And then I guess just last thing to say is that, and again, when I make these Python videos, we're going to be really digging through the data ourselves. But when you look at the metrics, for example, when it comes to portfolio management, one of the metrics people care about is called drawdown, which means the maximum amount of money you lose, like from the very peak down to the very trough, is called like your max drawdown. And of course, you want that number to be as tiny as possible. When you diversify across the factors, your max drawdown stat, for example, actually decreases. So your most devastating loss is actually smaller. And then another metric people care about when it comes to portfolio management is what's the longest amount of time that you went without making money, right? Or like the longest amount of time while still having a negative return, right? Which would be, let's say, all the way from here. What if you put all your money in right here? You're not going to make it back, right? What if this is like, 2 years or something, right? In reality, there can even be 10-year periods of negative returns. Generally, of course, you would want that number to be as small as possible. When you diversify across the factors, you decrease your drawdown and you decrease the amount of time it is, while still having a negative return. So it also, what's really important to know is that it also, it increases the reliability of returns. And there's something else we talk about in finance, which is called sequence risk, sequence of return risk, which, especially affects like retirees. Let's say you are a retiree and your time horizon is like 10 years. It means you only have one 10-year sample left. What if your only roll of the dice is the 10 years that your premium breaks? You can also help. It also helps with sequence of return risk to diversify across the different factors as well. So this is how we can start to build quite robust portfolios. So real quick, before we close out, last thing I wanted to talk about, obviously made that quant finance video. I said I spend a lot of my time not just studying computer science and not just studying asset pricing and monetary economics, but studying quant finance and actually doing computational finance, data stuff, blah, 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 whatever in code. That video you guys really liked. I was thinking about making a part 2 and a part 3 and a part 4. I was thinking maybe one on mean variance optimization and more modern portfolio theory, maybe a couple on stochastic modeling. Obviously, we're going to do one on factor regressions, which is actually pretty important. I just wanted to show you that I made this website. It's like sort of like halfway almost deprecated. It's not actually being hosted right now in any sort of production ready environment. But I made this website, and it's sort of almost like a clone of Portfolio Visualizer. Portfolio Visualizer was like, one of like just like a legendary website. Even my friends that, studied finance and work in finance right now, even they would use it. It's just like, oh, you want to run a quick back test, like boom, just pull Portfolio Visualizer. It was a great website. I made one that, has some really important features that it doesn't offer. Couple years ago, it turns out Portfolio Visualizer actually like just paywalled the entire website, which is kind of crazy. If there's interest, I can definitely go ahead and put this one back on production and stuff. But basically, what I have is just some basic functionality. For example, you can backtest securities. I'm just backtesting like the SPY ETF. And all this is done in a Python backend. This is just like a JavaScript plotting thing. In most of this, we actually covered already in that first video, like annualized returns, annualized volatility, max drawdown, the date, all this stuff, and like the wealth index stuff. If you watch that first video already from 2 years ago, you can actually do all this. What I did for like, there was a solid maybe year where like every single day I would just study stuff and read research and, and I ended up building like a pretty big Python library, just having literally a function for annualized return, right? And then I made a website, you can go ahead and put in portfolios with weights and save it to your account, blah, 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 but one thing I made that isn't offered on Portfolio Visualizer, or at least, many, many years ago, at least without paying, is, for example, inflation adjusting, right? Maybe you want to view nominal returns, maybe you want to view real returns. I actually pull data, like literally using APIs, like from the Bank of Canada and from like Fred and whatnot in the US, and I actually pull CPI data, and we learn about how you actually use a time series of that data to adjust your returns. Same as currency adjusting and currency hedging. I actually pull daily exchange rate data from the central banks, and I can go ahead and actually do that type of thing, right? So it's a few extra things, sort of. But as I run through all these quant finance videos, again, if there's even interest at all for finance stuff, we can start to build things like this. Rolling returns, for example, is a good one. You can go ahead and set a roll window and perform rolling return analysis. Maybe I'll even do that next. Rolling returns is pretty simple. Factor regressions, obviously, right? And then with factor regressions, I was saying that I believe momentum's a real factor. A lot of people do. It wasn't put into the Fama-French 5-factor model, so I actually pull the 5-factor model and pull momentum and create my own like 6-factor model, and then you can actually use this 6-factor model to perform factor regression. A lot of what you end up doing in finance, obviously, depending on what you're doing and whatnot, might not be offered on a website. Maybe you need to write your own code and whatnot. It just gives you crazy flexibility. So I just wanted to mention that. Maybe I'll put it on prod, but some of that you have to look forward to for future videos. So yeah, that's about it. I know the second I click on stop recording, I'm going to think of like 10 other things that I should have included. I wasn't sure, should I include discounted cash flow stuff, like, efficient market stuff. Like there's still like basic things I didn't even cover. I don't even know how long I've been filming for. Obviously, this is like an unscripted video. I know I'm going to think of a bunch of things I should have included. Either way, let me know, like genuinely, actually let me know in the comments. Do you want to see more computational finance videos in Python, like the first one? Do you want to see more of these unscripted videos where I just talk about research and talk about asset pricing and other things? I was thinking about doing one on monetary economics where I talk about like the hierarchy of money and credit and all that stuff, just to, I guess, bring people up to speed. This is more like foundational level, but it might also be more interesting to more people. So let me know how far you made it, and let me know if you want to see more finance stuff, and if you do, what finance stuff. Obviously, I'll still upload computer science stuff and bug bounty stuff and Tor stuff and whatnot. But yeah, so I think that's it for now. Listen, I love you guys so much. Thanks for the support on all my videos. Yeah, I think that's about it. So yeah, let me know. And as always, thanks for watching.